In 2008, a group of MIT-trained economists and finance PhDs managed a hedge fund that lost 73% of its value in a single year. Not because of fraud, not because of bad luck, because they were too smart. They built models so sophisticated, so layered with variables and assumptions, that they couldn't see the simple things staring them in the face. The market had changed, and they hadn't. Meanwhile, a retired schoolteacher in Ohio who put her savings into a basic S&P 500 index fund and never touched it lost 38% that same year and fully recovered within 4 years. The PhDs never recovered at all. The fund closed in 2010. That story isn't an accident, it's a pattern. And if you have above-average intelligence, above-average education, or above-average confidence in your own reasoning, you are specifically at risk. Here's the claim I'm going to prove to you in the next 12 minutes. Intelligence is not an advantage in investing. In most cases, it is a liability. The smarter you are, the better you are at constructing convincing reasons to do the wrong thing. Your brain, the same brain that got you the degree, the promotion, the respect of your peers, is actively working against your financial future. Not because you're broken, because you're human. And your human brain was never designed for financial markets. The investment industry knows this, and it profits from it every single day. Let's start with recency bias, the cognitive shortcut where your brain assigns disproportionate weight to recent events when predicting the future. Psychologists Daniel Kahneman and Amos Tversky documented this in their landmark 1974 paper on cognitive heuristics, and what they found was stark. People don't reason from data. They reason from vivid, recent memory. When the market has gone up for 3 years, your brain tells you it will keep going up. When it crashes for 6 months, your brain tells you it will keep crashing. Neither prediction has any statistical basis. Both feel completely logical. Here's what recency bias costs you in real numbers. Dalbar, the financial research firm, has tracked investor returns versus market returns for over 30 years. Their 2022 quantitative analysis of investor behavior found that the average equity fund investor earned 6.81% annually over the previous 30 years. The S&P 500 returned 10.65% over the same period. That gap, nearly 4 percentage points every single year, is not explained by fees. It's explained by timing. People buy after markets rise and sell after they fall. Recency bias in action. On a $100,000 investment held for 30 years, that difference is the gap between $700,000 and $2.1 million. That is what a cognitive bias costs you. Now add herd behavior. Robert Shiller at Yale, who won the Nobel Prize in Economics in 2013, spent decades studying what he called narrative economics, the idea that markets don't move on fundamentals. They move on stories that spread through populations like viruses. When everyone around you is buying crypto or tech stocks or real estate, your brain interprets their behavior as information. Surely all these people know something. The social proof mechanism that evolved to keep you safe in tribal environments tells you to follow the crowd. And the crowd, historically, is most unified and most confident right at the peak, just before the collapse. But here's where intelligence makes it worse. Smart people don't just follow the herd blindly. They rationalize it. They construct elaborate, internally coherent arguments for why this time is different, why the fundamentals support the trend, why the skeptics are missing the point. This is confirmation bias, the tendency to seek, interpret, and remember information that confirms what you already believe. And the smarter you are, the better you are at this. Psychologist Jonathan Haidt at NYU calls this motivated reasoning, and he describes the conscious mind not as a scientist searching for truth, but as a lawyer defending a conclusion that was reached emotionally. You decide you want to buy the hot stock. Then your intelligence builds the case. You think you're being rigorous. You are being brilliant in the wrong direction. There's a fourth bias that almost nobody talks about in financial content: the illusion of explanatory depth. Research by cognitive scientists Frank Kiel and Leonid Rosenblit showed that people dramatically overestimate how deeply they understand complex systems, until they're asked to explain them step by step. Ask most investors to explain exactly how a leveraged ETF compounds over time, or what duration risk does to bond prices in a rising rate environment, and they'll discover that their confidence was not backed by comprehension. Complexity feels like sophistication. It rarely is. None of this is accidental. The financial services industry is architecturally designed to exploit these biases, and it generates roughly $500 billion in annual fees in the United States alone, according to McKinsey's Global Asset Management reports. Think about what that system requires to sustain itself. It requires you to believe that complexity is necessary. It requires you to trade frequently. It requires you to feel that professional management of your money is worth paying for. It requires your recency bias because you switched to last year's top-performing fund just as it regresses to the mean. It requires your herd behavior because bubbles generate transaction volume. It requires your confirmation bias because a good salesperson will show you only the data that supports whatever product they're selling. Financial media is part of this system. Every hour of CNBC, every hot take on financial Twitter, every urgent email from your brokerage about market-moving events, all of it is engineered to create the sensation that you need to act right now. That inaction is dangerous. The data says the opposite. Vanguard's research shows that investor portfolios with no trades over a 10-year period outperformed portfolios with high trading frequency by an average of 1.5% annually. The action itself is the cost. Who benefits? Asset managers collecting fees on complex products, brokerages earning commissions on trades, financial media selling advertising against your anxiety. Your intelligent, active engagement with your investments is not a virtue. It's their revenue model. Here's what I've observed in working with people at the extreme ends of the wealth spectrum, and what the research consistently confirms. The ultra-wealthy are remarkably boring investors. Not in their businesses, not in their careers, but in the way they hold and grow existing wealth. First, they separate signal from noise by establishing rules in advance, not in the moment. Warren Buffett's famous rule, be fearful when others are greedy, be greedy when others are fearful, is not a feeling. It's a pre-committed behavioral protocol that removes real-time emotional decision-making entirely. He wrote the rule when he was calm. He executes it when everyone else is panicking. Second, wealthy investors obsessively reduce the number of decisions they make. Research by Shlomo Benartzi at UCLA on behavioral finance and retirement accounts found that the more investment options employees were given, the worse their outcomes. More choices meant more opportunities for bias to operate. The wealthy solution is ruthless simplification. Fewer accounts, fewer asset classes, automated contributions, automatic rebalancing. Decisions made once, executed forever. Third, and this is the one that surprises people most, genuinely wealthy investors are deeply comfortable with looking unsophisticated. When the Vanguard founder John Bogle was asked at a financial conference why anyone should trust such a simple strategy as a total market index fund, he said, "Because it works, and complexity in this industry mostly works for the people selling it." The social pressure to have a sophisticated portfolio, to talk about your alternatives allocation or your factor tilts, is enormous. Wealthy investors who've built durable wealth largely ignore it. Step 1. Write an investment policy statement today before you make another single financial decision. This is a one-page document that states your goals, your time horizon, your asset allocation, and the specific conditions under which you will change that allocation. The rule is simple. If the reason for a change isn't in the document, you don't make the change. This externalizes your discipline. You are no longer fighting your emotions in the moment. You're consulting a version of yourself that was thinking clearly. Step 2. Institute a mandatory 72-hour waiting period on every investment decision that feels urgent. Urgency is a bias trigger, not a market signal. If the opportunity requires you to act in the next hour, it is almost certainly not an opportunity. It is a sales tactic or a panic response. The 72-hour rule costs you nothing on genuine long-term opportunities. It protects you from almost every impulsive mistake. Step 3. Audit your information sources and cut them by half. Every additional source of financial news you consume increases your exposure to recency bias and herd behavior without increasing your actual signal quality. Research by Nassim Taleb in his work on noise versus signal in financial data shows that the more frequently you check your portfolio, the more random noise you interpret as meaningful information, and the more likely you are to trade. Check your long-term investment portfolio quarterly, not daily, not weekly, quarterly. Step 4. Embrace the simplest structure that meets your needs. For most people building long-term wealth, this means a 3-fund portfolio: a total domestic stock market index fund, a total international stock market index fund, and a bond fund in proportions appropriate to your timeline. This is not a dumbed-down strategy. This is the strategy that Jack Bogle, Eugene Fama, and Burton Malkiel, between them holding multiple Nobel Prizes and decades of market research, have all converged on. Complexity beyond this needs to justify its cost in both fees and mental overhead. Most of the time, it cannot. The most dangerous investor in the room is the one smart enough to talk themselves into anything. And the most powerful financial decision you will ever make is choosing a simple system and then protecting it from your own brilliance.